Hello all, my name is Siddharth. I am a chartered accountant, and today we are going to understand capital gains on house property. So this presentation and video is solely for educational and academic purposes. This is not intended to be a professional advice or need to be considered as a guidance for any practical life implications. So the topics that we are going to cover under capital gains is period of holding, capital gains tax rates, computation of short-term capital gain, computation of long-term capital gain, the elements of the computation, that is a sale consideration, cost of acquisition, cost of improvement, expenses incurred for sale. Then the concepts such as set off and carry forward of losses, gift, exemptions on reinvestment, one of the important topics on capital gains on house property, advance money received, TDS provisions and miscellaneous provisions. Miscellaneous provisions such as compulsory acquisitions. Getting on to the first topic, that is period of holding. For period of holding, just remember 24 months, more than 24 months, long-term capital gain on house property, less than 24 months, short-term. Now, this 24 months is an amendment in the budget 2024. Earlier, it was 36 months. Now, it is 24 months. The only other point that needs to be understood in period of holding is that where the property was acquired by will or inheritance, the period of holding of the previous owner will also be included. Moving on to the capital gain tax rates. The tax rate for short-term capital gain, there is no specific tax rate. It is included in the slab rate. Tax rate for long-term capital gain, always remember only two rates here. One is 20% with indexation, 12.5% without indexation. And the date, if the property is sold before 23rd July 2024, it is 20% with indexation. If the property is sold after 23rd July 2024, it is 12.5% without indexation. 23rd July 2024 is the date of the budget after which the amendment and the introduction of the new tax rate, that is 12.5%, came about. So that is why this budget date is to be remembered. Moving on to computation of short-term capital gain. This is covered under Section 48 of the Income Tax Act. Short-term capital gain computation is pretty straightforward. It is a sale consideration, deduct the cost of acquisition, cost of improvement, expenses incurred for sale, and you get the short-term capital. Moving on to the computation of long-term capital gain, again covered under Section 48 of the Income Tax Act. Now, there are two situations here. One is where the property is bought and sold on or after the budget date. There, the computation is pretty straightforward. It is a sale consideration, less cost of acquisition, cost of improvement, expenses incurred for sale, you get the long-term capital gain. This is similar to the short-term capital gain computation. Here, the computation mechanism is the same as for the short-term capital gain, and the tax rate would be 12.5%. Situation 2 is where the property is bought before the budget date and it is sold after the budget date. In this situation, we have to compute the capital gains under two methods. One is the new mechanism, that is taxpayer to calculate capital gains without indexation at 12.5% tax rate. That is a new provision. The taxpayer should also calculate the capital gains as per the old provision, that is with indexation at 20% tax rate. After computing the capital gains as per the new provision and the old provision, whatever tax is in excess because of the new provision, that much tax needs to be ignored. Whatever the excess capital gain tax arises, if any, in point number 1, that is a new provision, vis-a-vis point number 2, that is the old provision, needs to be ignored. Now, let's understand point number 2. Let's understand how to compute the capital gains under the old provision. For that, we must understand what is indexation. Now, indexation is basically used for cost of acquisition and cost of improvement. Cost of acquisition is converted into an indexed cost of acquisition. Indexation is basically units or measurements for inflation, cost inflation index that is released by the central government for every financial year. So these two tables that we have given here indicate the cost inflation index that has been released. 2001 to financial year 2001 is the base year, which is 100. And after that, all these inflation points are kept to calculate the indexed cost of acquisition or indexed cost of improvement. So if you want to calculate indexed cost of acquisition, for example, you take the cost of acquisition, you multiply the cost inflation index for the year of transfer or sale, and divide it with the cost inflation index when the asset was bought, or financial year 2001 to whichever is later. For example, if your cost of acquisition is 10 lakhs and your year of sale is 24-25, that is, you have sold it now, and you had bought it in, let's say, financial year 2006-7. So you take the 10 lakhs cost of acquisition, you multiply it with the cost inflation index for the year of transfer, that is, let's say 24-25. So cost inflation index would be 363, multiplied with 363, divided with the cost inflation index for the year in which it was bought, let's say financial year 6-7, that is 122. Now, cost inflation index for the first year in which the asset was held by the SSG, or the financial year 2001 to whichever is later, is because if the asset was bought before 2001 to, then you take 100 divided by 100, take the base year and divide it by 100, right? Next, this note is basically the amendment that was brought in the year 2024, budget 2024. Let's read. The Finance Act 2024 removed the indexation benefit and introduced a uniform tax rate of 12.5% on LTCG. As per the amendment, no indexation benefit is allowed while computing capital gain from long-term capital asset transferred on or after 20th July 2024. However, the government has introduced a grandfathering provision. This provision allows resident individuals and resident HUFs to still apply indexation on land or building acquired before 20th July 2024 and pay tax at the old rate of 20% if the tax under the new law of 12.5% without indexation results in a higher amount. As per the grandfathering provisions, if the amount of tax under the new law exceeds the amount of tax under the old law, the excess amount shall be ignored. Next. This is an example of computation of the long-term capital gain in situation 2. So first we calculate it as per the old provision, that is full value of consideration, let's say 20 lakhs 10,000 less expenses incurred for sale, for example, brokerage 10,000. Net sale consideration is 20 lakhs. Indexed cost of acquisition is the actual cost, that is, let's say 4 lakhs, multiplied by the cost inflation index of this year 363 divided by cost inflation index of the year 6-7 122. Assuming cost of improvement is nil, long-term capital gains and capital gain tax at 20% comes to 1,61,000. Then we calculate it again in the new provision, as per the new provision, wherein we take the full value of consideration, deduct the cost, 20 lakhs, cost of acquisition, actual cost of acquisition, that is 4 lakhs, cost of improvement nil, long-term capital gain becomes 16 lakhs, and the capital gain tax at 12.5% becomes 2 lakhs. So here you can clearly observe the new provision tax is higher than the old provision. So whatever the excess because of the new provision needs to be ignored. So capital gains would be restricted to 1,61,000 since the capital gain tax under the new computation is more than the capital gain tax under the old computation. So next we'll understand the elements of the computation. Sale consideration. Sale consideration is nothing but whatever amount you agree to sell your house property. But always when you are considering the sale consideration for the purpose of computation, you should look at the stamp duty value of the house property that you are selling. Now, if the stamp duty value is more than the sale consideration, then the stamp duty value will be considered as a sale consideration. So the only leeway that has been given is if the stamp duty value is not more than 110% of the sale consideration, you can take the sale consideration as the for the purpose of computation. This has been brought about from the assessment year 2019-20. The other point is when you are considering the stamp duty valuation, what is the point at which stamp duty value would be considered or computed? So there will be two dates when you are selling a house property. One is the registration date of the sale of the house property. Second is the agreement date of the sale of the house property. Now, the agreement date would be considered as the date on which the stamp duty value has to be computed only if the full value of consideration or a part of the consideration has been received before the date of the agreement. If it has not been received before the date of the agreement, then the registration date has to be considered for the purpose of computing the stamp duty value. Next, we'll understand what is the cost of acquisition. Cost of acquisition covered under Section 55 of the Income Tax Act. Now, cost of acquisition is pretty simple. Whatever is the cost at which you had bought the property, that would be the cost of acquisition. Only one exception here is if the property was acquired before the 1st April 2001, then you have two options. Either the actual cost of the property that was acquired before 1st April 2001, or the fair market value of the property as on 1st April 2001 can be considered as the cost of acquisition. Now, only one thing that needs to be remembered here is that the fair market value as on 1st April 2001 cannot be more than the stamp duty value as on the 1st April 2001. So that is cost of acquisition, either the actual cost of acquisition or if it is before, if the acquisition has been done before 1st April 2001, then the actual cost of acquisition or the stamp duty value as on 1st April 2001 shall be taken as the cost of. Then comes to cost of improvement. Cost of improvement is basically any expenditure that has been done on a capital nature for making any additions or alterations to the capital asset by the SSE. This is again covered under Section 55 of the Income Tax Act. Improvement costs incurred before 2001 should be ignored. It should not be considered. Then coming to expenses incurred for sale, these are basically examples of the expenses incurred for sale. It can be brokerage, commission, advertisement expenses, anything that has been incurred for making the sale of the house property. That were the elements. Sale consideration, that can be actual sale consideration or the stamp duty value. Cost of acquisition is the cost of acquisition unless it is before 1st April 2001, in which case it will be cost of acquisition or the fair market value as on the 1st April 2001. Cost of improvement, any capital expenditure made. Expenses incurred for sale, brokerage, commission, advertisement expenses for the purpose of sale of the house property. Now coming to the concept of set off and carry forward of losses. Let's say you bought a property for 1 crore, you sold it at 80 lakhs, you got a loss of 20 lakhs. Let's say it's a long-term capital loss. Then such long-term capital loss on the sale of property can be set off with a long-term capital gain from any other asset. So let's say you sold gold, long-term capital gain, you got 30 lakhs as long-term capital gain, and you have 20 lakhs of long-term capital loss on the property, then it can be set off. Any excess loss that could not be set off in the current year can be carried forward to 8 subsequent years, but that can also be set off only against another long-term capital gain. Short-term capital loss can be set off against short-term capital gain or long-term capital gain. Again, it can be carried forward for 8 subsequent years and it can be set off against short-term capital gain or long-term gain. For carry forward of losses, income tax return to be filed before the due date. So if you have a loss in that year, please make sure that the income tax return is filed before the due date. Now, there is one thing that needs to be understood here, that for the computation of long-term capital loss for sale on or after 23rd July 2024, the grandfathering provision is to be ignored for the computation, and the computation should be as per the new law, that is without indexation. So this is regarding the situation 2 that we talked about, wherein the property was bought before the budget date and it is sold after the budget date. In that situation, for computation purposes, we had computed it as per the new provision and the old provision, and the excess of the tax that is to be paid as per the new provision is to be ignored. But for the purpose of set off and carry forward of losses, only the new provision needs to be computed for the purpose of computation of the long-term capital loss. Then coming on to gift. So this is covered under section 47(3). So let's see. Giver of the gift. If you are gifting a house property to somebody, then effectively a gift is a transfer of the house property to somebody, but section 47 covers all those provisions wherein a transfer has been exempted from the meaning of the word transfer. So if a person gives his capital asset, that is a house property, to another person, then no capital gain will arise in the hands of the person making the gift. So if you are making the gift, there is no capital gain in your hands. Now, what about the receiver of the gift? Now, the receiver of the gift is covered under section 56(2). It is covered under income from other sources. It is not coming under capital gains. So 56(2)(10) covers the receiver of a gift in if the gift is of a house property, and it will be taxed under the head income from other sources. Now, section 49(4) covers the cost of acquisition in the hands of the receiver. So I am a receiver of the gift as a house property, and now in the future, I go and sell the house property. So what will be my cost of acquisition? So section 49(4) says your cost of acquisition will be the value which was considered to tax you under section 56(2) when it was received as a gift. So whatever the value that was considered to pay tax under section 56(2) at the time when the gift was received, that value will be considered as the cost of acquisition for the purpose of computation. So to summarize, gift 47(3) exempts the gift as a transfer. So giver of a gift, there is no capital gain. Receiver of the gift taxed under income from other sources under section 56(2)(10). And the receiver of the gift, when he sells the gift in the future, sells the house property in the future, then section 49(4) kicks in, wherein the cost of acquisition will be the cost of acquisition, will be the value considered for paying tax under section 56(2)(10) at the time when the gift was received. Exemptions on reinvestment. One of the important topics in capital gains on house property. Now, exemptions on reinvestment has four main sections relating to house property. Section 54, 54B, 54EC, and 54F. The basic funda of exemptions on reinvestment is basically when you sell a capital asset, you get a gain. You reinvest that gain or the consideration into a new capital asset, specified new capital asset. And if you reinvest that, then the capital gain that you got from the original asset would be exempted. Whenever you're reading these provisions, you have to look at four main provisions. One is what to reinvest. Second is when to reinvest. Third is what is the limit of reinvestment. And fourth is what happens if you sell the new capital asset early. So coming to section 54, 54 says long-term capital gain from sale of a residential house property. What to be reinvested? The gain that you get from the sale of the residential house property, the long-term gain, that needs to be reinvested in the purchase or construction of one residential house property. Now, there is one exception, that is you can make an investment in two residential house properties in India if the amount of the gain does not exceed 2 crores. And that option can be made only once in a lifetime. Second is when to reinvest that. When to reinvest, you sell it today, then you can reinvest that gain either 1 year before the date of transfer or 2 years after the date of transfer if you are purchasing a residential house property, and 3 years after the date of transfer if you are constructing a residential house property. Now, what is the maximum limit that you can reinvest? It is 10 crores. So if you have a gain of a long-term capital gain of 20 crores and you reinvest 20 crores, then it will be limited to 10 crores exemption. Then we should look at what happens when you sell the new residential house property within a period of 3 years from the purchase or construction of the property. So let's say you reinvested in a residential house property and you sold that new residential house property within 3 years from the date of purchase. Then whatever capital gain that you would compute for the sale of the new asset, take that cost of acquisition for that and you reduce the capital gain that was exempted for the sale of the original asset. Then the last point is, if the amount in the capital gain account is not utilized within the time period, now capital gain account means it says when you sell a capital asset today, when you sell a residential house property today, and you have time to reinvest that amount in 1 year before, or 2 years after, or 3 years after, if it is construction. Which means by the time you file your return of income, it has not been completely reinvested. So what the provision says is you put that amount in a separate bank account, which is called the capital gain account scheme. So whatever amount you put in that account, that will be considered as a exemption for the purpose of that financial year when you sold the asset. Now you have to reinvest that amount that you have put in the capital gain account within the time period. Now suppose the time period ends, that is 3 years from the date of transfer ends, and there is some amount remaining in that capital gain account, then that amount that is remaining in that account, that would be taxed in that year under the head capital gain. In that year meaning at the end of the 3 years. That is section 54. 54 deals with long-term capital gain on sale of residential house property. Coming to section 54B. 54B talks about long-term capital gain or short-term capital gain on land that is used for agricultural purpose. Now, what is the condition? What are you selling? You're selling a land. Let's say you have a land in a city that you or your parents have used for agricultural purposes for at least 2 years immediately preceding the date of transfer. If that is the land that you're selling, then what needs to be reinvested? Whatever gain that you are earning from the sale of that land, that needs to be reinvested in the purchase of another land, which is purchased for being used for agricultural purposes within 2 years from the date of transfer. Then what happens when you sell the new land? If you sell the new land within 3 years of purchase of the land, then again it is similar to section 54, wherein it says whatever the capital gain that you are computing for the sale of the new land, the cost of acquisition has to be reduced with the capital gain that was exempted for the original land. Then this amount, the capital gain account scheme, it is the same provision as was for section 54. Only difference is if the amount is not utilized within a period of 2 years from the date of transfer, then it will be taxed in the year in which the 2 years expires under the head capital gains. That is section 54B, long-term or short-term capital gain on land which is used for agricultural purpose. Then moving on to section 54EC. 54EC talks about long-term capital gain from the sale of land or building. Now here, what needs to be reinvested? The gain. The gain, long-term gain from the sale of land or building has to be reinvested. It has to be reinvested in what? It has to be reinvested in bonds. Now, NHAI and RECI are two corporations which issue bonds, which are 5-year redeemable bonds. If you invest the gain in these bonds within a period of 6 months from the date of transfer, then the capital gain becomes exempted. Now, the limit is whatever capital gain that you earn from sale of land or building during one financial year, cannot be reinvested more than 50 lakhs. So if you have a long-term capital gain of 60 lakhs total aggregate from land or building, then for that financial year, if you want an exemption under 54EC, you can only reinvest 50 lakhs to get maximum 50 lakhs exemption can be gained. Then what if you sell the bonds early? Early means what? Early means 5 years. Where the bonds are transferred or converted into money within 5 years from the purchase of the bonds, then the capital gain. Now, this is different from the other section 54, 54B because the capital gain that was used to purchase these bonds will be taxed as capital gain in the year of sale of bonds. So the difference is that in 54EC, if you sell the bond within 5 years, then the capital gain would be taxed in that year in which the bond is sold, the capital gain that was exempted. Unlike section 54, 54B, wherein the cost of acquisition in the computation of the new asset will be reduced by the capital gain that was exempted. Okay? Now, this provision says where the bonds are transferred or converted into money. Now, what does converted into money mean? Converted into money means, let's say you have purchased the bonds. Now, you have the bonds and you take the bonds, go to the bank, keep the bonds as security and take a loan against those bonds. If you take the loan against the bonds, it will be considered as converted into money. And the capital gain would be taxed in the year in which you converted that into money. Okay, that is section 54EC, long-term capital gain from land or building reinvested in bonds, NHAI, RECA, 5-year redeemable bond. Moving on to the last section on exemptions on reinvestment, section 54F. 54F talks about long-term capital gain from any capital asset other than residential house property. Why other than residential house property? Because long-term capital gain from residential house property has already been given in section 54. So 54F says long-term capital gain from any capital asset other than residential house property. What needs to be reinvested? Now, this is different from other section 54s because the net sale consideration has to be reinvested, not the gain. The net sale consideration to be reinvested in purchase or construction of only one residential house property. When it needs to be reinvested, that is similar to section 54, 1 year before the date of transfer or 2 years after the date of transfer or 3 years if you're constructing a residential house property. What are the conditions? One condition is on the date of transfer, the taxpayer does not have more than one residential house property. So let's say you sold gold, you got 20 lakhs of long-term capital gain. When you sold the gold, you have only one residential house property and you're reinvesting that gain, the sale consideration, in another residential house property. So you can reinvest it in a second residential house property. So if you already have two residential house properties and you're reinvesting it in a third residential house property, then the condition will kick in and you cannot use section 54F. Second condition is that taxpayer does not buy more than one more new residential house property within 1 year of the date of purchase of the reinvested house property or constructs a residential house property within 3 years from the date of the purchase of the reinvested house property. Basically, this restricts a taxpayer from getting another new house property after it has reinvested in a new house property. Within 1 year, if it is a purchase, within 3 years, if it is a construction from the date of purchase of the reinvested residential house property. The limit is the same as section 54. Maximum exemption limit is 10 crores. Now, how would you compute the exemption on the capital gain if you are going to reinvest in a residential house property which is less than the net sale consideration that you have received in the original asset? So let's say you got a net sale consideration of 1 crore, you reinvested 80 lakhs into a new residential house property, and the capital gain that you had earned in that 1 crore property was 40 lakhs, let's say. So how much of those 40 lakhs will be exempted if you are only reinvesting 80 lakhs of the net sale consideration, it will be 40 lakhs into 80 divided by 1 crore. That is 80 by 100, that is 80%. So the exemption on the gain would be 80% of the 40 lakhs. Now here also, this is similar to section 54 EC. If you are selling the new residential house property, within 3 years of the purchase, the capital gain exempted will be taxable in the year of sale. Now, this is one point that needs to be understood. One is, this is an interesting thing. Taxpayer, this is a situation, let's say, taxpayer sells a capital asset in year 1 and reinvests it in a construction of a residential house property. So it has 3 years to construct a residential house property. It is reinvesting it in one more residential house property. Now in year 2, in the next year, the taxpayer again sells another capital asset and it reinvests the sale consideration into the same construction of the residential house property. So in year 1, it took section 54F exemption. It reinvested the sale consideration into construction of a residential house property. In year 2, it again sold another capital asset, reinvested that sale consideration into the construction of the same residential house property. Can it be allowed? Can section 54F used in year 2 as well? The answer is yes, because all the conditions are getting met. Even in year 2, if you're selling a capital asset, you're taking the sale consideration, you're reinvesting it in the construction of a residential house property, you will get the exemption. Moving on to the next topic, that is advance money received. Advance money received is a situation where you have a house property, you want to sell the house property to a third party. You negotiated it with a party to sell the house property. You took an advance, let's say 1 or 2 lakhs, and then the negotiations did not close and you retain that advance money. So where you retain the advance money and you do not sell the house property, then that advance money that you have retained or earned becomes taxable under income from other sources under section 56(2)(9). There is no other implications under capital gains. Now let's understand TDS on house property. TDS is covered under section 194IA of the Income Tax Act. TDS is applicable for the buyer of the house property. Now, how much TDS is applicable? The purchaser of land or building other than agricultural land has to deduct 1% of the consideration or the stamp duty value, whichever is higher, at the time of payment of the consideration. Now, you deducted TDS of 1%. Now, when it should be paid to the central government? Usually, TDS is paid for businesses and companies within 7 days from the end of the month. But in case of 194IA, in case of TDS and a house property, TDS has to be paid within 30 days from the end of the month in which a deduction is made by way of a challan cum statement of Form 26QB. Rule 30 and 31A talks about it. Now, the duty of the deductor is not complete here. It has to, within 15 days of the due date of furnishing Form 26QB, download Form 16B and send it to the seller. This is Rule 31 of the income tax rules. Now, usually for a deductor of TDS, in case of businesses, they have to obtain a TAN under Section 203A. Now, for Section 194IA for TDS under house property, TAN is not required and not applicable. Now, what are the conditions? When do you need to deduct TDS? If you're buying a property from a resident seller. Second, if the value of the property is more than 50 lakhs, either the value of the property, that is sale consideration, or the stamp duty value is more than 50 lakhs, then TDS becomes applicable. Now, one point to note here is that it is not to be seen per transferee or per transferor when you're looking at the limit of 50 lakhs. For example, if there is more than one buyer or more than one seller, then the sale consideration or part of the transfer is not to be looked at. The whole house property's value or the stamp duty value has to be looked at for the limit of 15 years. Now moving on to the miscellaneous provisions. So the first topic is insurance money covered under section 45(1)(a) of the Income Tax Act. This is basically where you have a house property and it gets destroyed or damaged, you get the insurance money for it. Then for the purpose of computation of the capital gain, the insurance money received, or if you get an asset in place of money, then the fair market value of the asset would be considered as the sale consideration. Then agricultural land. Now, what I have done here is I have summarized the provisions of agricultural land here, starting with section 214. So, rural agricultural land, section 214 deals with the definition of capital asset. Now, rural agricultural land is not a capital asset itself. So, it doesn't, so you sell rural agricultural land, you buy rural agricultural land, capital gains is not involved because it is not a capital asset. Now, what about urban agricultural land? Section 1037 says if urban agricultural land is transferred because of compulsory acquisition. Compulsory acquisition meaning the government comes to you, tells you that they want the agricultural land to make a road or a bridge or a track, and they compulsorily acquire it. And if it is urban agricultural land, then it is exempt. Whatever consideration you receive is exempt under section 1037. Lastly, section 54B, this we have gone through in detail in the previous sections. Here, land used for agricultural purpose, you transfer it, you get the gain, you reinvest that gain in a agricultural land again, then the capital gain on the original land becomes exempt. That is section 54B. Next comes a distinction between capital asset versus stock in trade. Basically, if you're dealing in house property, you're buying house property, you're selling house property. If you're a dealer in a house property, then it is not a capital asset, it will be a stock in trade. So here we have given an example. Mr. X is a property dealer. He purchased a flat for resale. The flat was purchased in 2020, sold in 2024. In this case, Mr. X is dealing in properties in his normal business. Hence, flat purchased by him would form part of stock in trade of the business and not a capital asset. Moving on to a situation. This is a situation where you have a land or a house and a developer comes to you, says, I will develop a building of 3 to 4 floors here and give you a part of that, that is, let's say, 1 floor with additional 50 lakhs of rupees and gets into a developer agreement with you, developing the real estate. This is a situation covered under section 45(5)(a). Situation is, let's read, an individual owning land or building or both enters into a registered agreement to allow another person to develop real estate project on such land or building in consideration of a share in such project, whether with or without payment of consideration of cash. So in this case, whatever consideration that you are receiving would be taxed under the head capital gain. How it will be charged? Capital gain shall be chargeable in the previous year in which the certificate of completion for the whole or part of the project is issued. Right? Once the certificate of completion is received, that is when the capital gain is chargeable. What would be the sale consideration? The stamp duty value on the date of the issue of the completion certificate of the share in the property that you are going to receive, and including the money that the developer will give you, that would be considered as the sale consideration. All other components of computation would be as per the other provisions. Cost of acquisition, cost of improvement, expenses incurred for sale, all those will be as per the other provisions. Sale consideration is sale consideration, and when the capital gain would be charged, that is mentioned in section 45(5) in this section. And the last miscellaneous provision topic that we are going to discuss is about compulsory acquisition. Again, compulsory acquisition is where you have a house property. Let's say the government comes to you, says we have to compulsorily acquire house property because of various reasons, such as want to make a road, track, bridge. In that case, obviously they will give you a compensation consideration that will be usually that compensation consideration will be considered as a sale consideration, and you'll compute the capital gain and pay the tax. But Section 45(5), what it says, the original compensation for the compulsory acquisition awarded would be taxed under the head capital gain in the previous year in which such compensation or part thereof, or such consideration or part thereof, was first received. Now, why it is important is because it is not like if you transfer by way of compulsory acquisition in this year, then it may not be necessary that you get the compensation in this year itself. You may get it after 1 year, 2 years, 6 months, whatever. So when you get the part of the compensation, when it is first received, the part of the compensation first received, that is the year in which the capital gain has to be taxed. Now, there is again a situation wherein the original compensation that was decided, you are not satisfied with it, you go to the court, you say you need more compensation, and let's say down the line 2 3 years you win the court case and you get an enhanced compensation. In that case, where subsequently the compensation is enhanced, the same would be taxable under the head capital gains in the year in which the enhanced compensation is received. Similarly, where the subsequently the compensation is reduced, the assessed capital gain shall be recomputed in that year. Then there is a section 54H. What 54H says is compulsory acquisition is nothing but a transfer of the capital asset wherein you get a gain. Now, section 54, 54B, 54EC, 54F, all these sections says that from the date of transfer, if you reinvest in another capital asset within 1 year before or 2 years after or 3 years after in case of construction, then the capital gain would be exempt. But in case of compulsory acquisition, the challenge is date of transfer would not be say the same as the date when you receive the compensation. Compensation may be received down the line 6 months, 1 year, 2 years. So in that case, section 54H says that time period for reinvestment will start from the date when the compensation is received. Lastly, there is a TDS provision, section 194LA. It will be deducted by the authority who would be giving you the compensation. TDS at 10% will be deducted if the compulsory compensation consideration would be more than 2,50,000. Thank you so much for watching the video on capital gains on house property. If you have any views on the provisions that has been mentioned in the video, please do put it in the comments below and we can engage. If you genuinely like the video, please do hit the like button, share it with anybody who you think would benefit, and so please subscribe to the channel. Lastly, if you want this presentation, then I have provided my email ID on the description below. Please do drop me an email. Thank you. Bye.